Have you ever come across the account of Ronald Red? He was a simple gas station attendant and part-time janitor who, upon his passing in 2014, left behind a staggering estate of $8 million. You didn't mishear that. A janitor with $8 million. He didn't hit a jackpot, nor did he come from a wealthy lineage. His secret was nothing more than disciplined, long-term saving coupled with a quiet, relentless force of compound interest. The takeaway is profound. Your financial outcomes are dictated far more by your temperament than by your IQ. You don't need a degree from an Ivy League school or a high-stakes job on a trading floor to build a fortune. You just need to master your own impulses. As the philosopher of finance Morgan Housel explains, wealth is less about what you know and more about how you conduct yourself. Invest the next several minutes in this breakdown, and you might just master the psychological side of the investment game. This is a deep dive into the 5 pillar concepts of the psychology of money by Morgan Housel. I'm here to provide the strategies you need to navigate the markets and claim your financial independence. Insight 1, accepting the entrance fee. Imagine you've spotted a high-end luxury car you've always wanted. You visit the dealership to take a closer look. You're dreaming of the status it brings and how it will elevate your image. In this moment, you have 2 paths. You can either pay the sticker price, or you can attempt to drive it off the lot without paying and hope your luck holds out. Most likely, you choose the first option. Regardless of how daring you are, you recognize that taking the car requires a legitimate transaction. You pull out your wallet and pay the bill. It's the cost of entry. Investing works exactly the same way. It demands a specific price. Throughout the discussions on this platform, we often see that the highest rewards come from focused strategies. However, a concentrated approach has a very specific side effect. It is incredibly turbulent. This turbulence is the fee you must pay for the privilege of achieving superior long-term growth. If you lack the mental fortitude to stay calm when your portfolio's value drops by 25% in a single month, perhaps because your top 2 companies hit a temporary rough patch, then you shouldn't be chasing maximum returns. Generally, the higher the potential payout, the more expensive this emotional fee becomes. Consider if you had the foresight to buy Amazon in the early 2000s. If you held it until today, you'd be incredibly wealthy. But could you have actually paid the price required for that journey? Amazon stock has weathered multiple brutal crashes. Would you have stayed the course in the late 90s or during the 2008 crisis when the price plummeted and your neighbors thought you were a fool? Could you look your family in the eye while your life savings seemed to be evaporating? While that is a dramatic case, even a conservative index fund approach requires you to pay the price of volatility. If you had parked your money in a total market fund 40 years ago, you would have endured over a decade's worth of time where your account was down significantly from its peak. It's a grueling experience. The stock market is a miracle for wealth building, but it isn't a free lunch. Every successful investor has to stare down volatility and accept it as the mandatory cost for a prosperous future. Insight 2, the trap of not enough. There's a strange psychological glitch where a person can be perfectly happy with a $1 million windfall until they realize their colleague received $1.1 million. Suddenly, that original million feels like a failure. The modern economy is excellent at 2 things: creating prosperity and fueling jealousy. The drive to outshine your social circle can certainly push you to work harder and innovate. Motivation is a net positive, but the social comparison treadmill can leave you feeling perpetually inadequate. Let's look at the ladder of wealth. To be in the top 1% of earners globally, you need a high 6-figure income. Imagine a successful corporate attorney. Let's call her Sarah. By any objective measure, Sarah is rich. She has the designer wardrobe, the luxury SUV, and the summer home. She felt incredibly accomplished until she moved into an exclusive gated community and met her neighbor David. David is a partner at a private equity firm making $15 million a year. Now, you'd think David would be satisfied, but he isn't. He spends his weekends with a tech founder whose company just went public for $3 billion. And compared to a multi-billionaire, David's massive salary starts to look like pocket change. And it doesn't stop there. Even that billionaire likely feels small when sitting in a room with someone like Elon Musk, whose net worth can fluctuate by tens of billions in a single day. There's always someone with a bigger boat. Throughout history, the envy born from these comparisons has pushed rational people to do irrational things. Some have gambled away their fortunes on high-leverage trades just to reach the next tier of status, only to end up broke. Others have crossed legal lines, sacrificing their integrity and their freedom for a little more cash. Many have ignored their spouses and children in the pursuit of more, only to find themselves wealthy and completely alone. As you build your wealth, you must eventually define where the finish line is. There's no reason to risk what you already have and truly need for something you don't have and definitely don't need. Insight 3. Logic is subjective. On the surface, it often looks like people are being completely reckless with their finances. Some blow their savings on status symbols, while others are too afraid to even put their money in a bank. But we have to remember that every individual is the product of a unique set of circumstances, different eras, different households, and different life lessons. What looks like crazy behavior to you might be a perfectly logical response to my life experience. Hosel points out the statistics regarding lottery tickets. The households with the lowest income in the country spend significantly more on the lottery than the wealthiest households. Simultaneously, a huge portion of the population doesn't have enough cash for a $400 emergency. To an outside observer, spending that emergency money on a 1 in a million chance seems insane. But try to look through their eyes. They are trapped in a cycle with no clear exit. They may feel that they have no path to a better life through traditional means. A lottery ticket is the only time in their week they get to own a dream of a different life. From that perspective, it's not crazy. It's a purchase of hope. How does this help you invest? It reminds you to stop comparing your strategy to others. By accepting that everyone has different goals, you'll be less likely to mimic a portfolio that doesn't fit your life. A retired billionaire is playing a game of wealth preservation, while you might be playing the game of wealth accumulation. If you copy the billionaire, you'll fail your own goals. Understanding that people see the world through different lenses allows you to ignore the noise, like the meme stock crazes, and focus on the path that actually leads to your specific destination. Insight 4, the unforeseeable factor. What did the Great Depression, the fall of the Berlin Wall, the 2008 crash, and the recent global pandemic have in common? They were the primary architects of our current world. They fundamentally altered the markets, and they were almost impossible to predict. Experts call these black swan events. They have 3 specific traits. They are total outliers with no historical precedent. They have a massive, world-altering impact. We create a rational explanation for them only after they happen. Our minds trick us into thinking we saw it coming. Imagine it's the 1987 market crash. How would you have behaved when the market lost 20% of its value in a matter of hours? Would you have panicked and sold everything? Or would you have had the discipline to stay calm or even buy more? Consider this. If you had invested in the market 20 years ago, but missed just the 4 best performing days because you were trying to time the market, your total return would be nearly cut in half. The lesson here is that it is far more effective to build a margin of safety into your finances than to try and play profit. Stop chasing the latest macroeconomic forecast. The events that will actually move the needle in the future are the ones that nobody is talking about right now. Insight 5, the allure of the doomer. If I spent the next 5 minutes listing all the reasons the global economy is about to collapse, citing rising debt, geopolitical tension, and resource scarcity, you would likely pay very close attention. You might even find my argument quite sophisticated. However, if I told you that the future looks bright because of medical breakthroughs, falling costs of renewable energy, and increasing global literacy, you'd probably find me a bit naive and boring. Why is pessimism so much more attractive than optimism? It's actually an evolutionary survival mechanism. As noted by experts in behavioral psychology, we are hardwired to prioritize threats over opportunities. In the wild, ignoring a threat meant death, while missing an opportunity just meant staying hungry for another day. We treat losses as much more significant than gains. We also listen to the doomers because destruction happens fast, while progress happens slowly. A forest takes decades to grow, but can burn down in a single afternoon. Because setbacks are dramatic and sudden, they make for a much more compelling news story. Optimism requires a long-term perspective, which is often quiet and lacks drama. Once you realize that your brain is naturally biased toward negative news, you can start to balance your perspective. The world generally trends toward improvement, even if the headlines say otherwise.